Welcome to Virtual Coffee with Dawn Rickabaugh, the Note Queen, where we talk about owner financing and notes. Financial solutions, one mom and pop to another.
All right. Well, welcome to the November, my goodness, it's going to be Thanksgiving, November 2019 Owner Financing and Notes Conversation Virtual Coffee. I really welcome you. Like I always say, it's one of my favorite things every month. I also enjoy my meetup group here locally in Carson City as well. But so thank you for spending the time, whether you're here live or listening afterward. It means a lot to me, and it really helps expand the conversation. I wanted to do just a really quick little mini lesson on wraps, okay? Because it came up for me recently, and I'm not going to use exact, names or situations, but I want to get pretty close because I want to show you, like putting a deal together where a guy came to me. He actually came through my website and the We Buy Carson website, where I buy property. And wanted to sell a property. He doesn't live here anymore, and I gave him a cash price, and I gave him a better price if he would leave his existing loan in place, and I could give him quite a bit more, $20,000 more. I think he talked me up a little more, $25,000 more on my offer if I could leverage his existing financing, and so that's the offer he chose. And I just want to show you there's the front end power of that. Let's say, basically I want to bring up my calculator right here. The part people don't see is the magic of the amortization schedule. And that's just kind of what I want to do a little lesson on before we get into the questions and bring on anyone live on the call that wants to chime in. So let's just say I bought this property for $155 with $15,000 down and taking over a balance of $140,000. Right. So, and then I turn around and I sell it for, I'm like, again, these aren't exact. So what if I can, without even touching it, we're not even talking rehab. This is hotel. Say, hey, handyman special. I'll sell it for $200,000 with $40,000 down, and I'll carry the rest, So we can see right there, well, if my purchase price is $155 and I sold it for $200,000, we know right there somewhere I at least now and later created $45,000 spread there. I'm not going to get it all now, right? Because if I took $40,000 down from the person I'm reselling to, but I have to come out of pocket $15,000 plus closing costs and a few other things, but just roughly, okay, I'm going to make $25,000 up front, maybe 23 by the time I'm done paying for some things, right? So $23,000 up front. But what I want to show you is you can get paid up front and then again on the backside with this strategy. So I'm going to recreate approximately, let's say this existing note is, and if you're just listening, I'm doing a demo on with a financial calculator, the HP 10B2, which all of you should have on your phone, on your computer, or a handle. I mean, there's just no excuse for not having a financial calculator. So please get that. Okay, so the original loan that these people got back in, what's 14 years ago? Is that 2006? So anyway, let's just say it was $206,000, 4.5% interest rate. I actually think it was, still waiting for an exact copy of the note, but from what I can tell, reverse engineering this. And there's zero in future value because it's fully amortized. Okay, so this is the monthly payment, $1,025.49. Now we are 14 years into this note. Okay, so what I'm going to show you is like I'm going to hit this orange button, the shift key, and I'm going to go over to this amort button that's the same as the future value button. Okay, and this shows the amortization. Okay, and of the whole loan, you can see at the beginning, interest was $746 of each payment, and principal was only $278. Still not bad, right? Still not bad. But now I'm going to use this share feature Okay, and you can do this to create PDFs of amortization schedules. It's super awesome. So I'm using this little share thing right there to PDF. It should ask me. It should ask me to, here it is. The loan date was, I'm gonna say, let's just call it whatever's 14 years ago. Was that 2005? Gosh. So I'm just gonna take this back and get really close to what the current amortization is. And I wanna say it was more like in April-ish time frame. I'll just make it the first. And I'm going to take this down. So you can create these exact sorts of things. So that's 15 years ago. It was probably 2005. That'd have been 14 years ago. That's about right. Okay. So that's my loan origination date right here. Now I'm going to share that, and I want to create a PDF. So it should bring it up real fast. So here you can see this PDF. We put the loan in. You can say the first payment was back in May. So by now, and we're going to look at these side by side, but just look at this. By the time I scroll down to where we are 14 years into, and why it's so powerful for me to take over a loan when it's seasoned like this, much more than if it's brand new, really. So let's go down. Here we are at, where are we at? November, December of 2019. So now you can see that we have a full 500 plus dollars going to principal reduction. So literally more than half the payment is, or almost, I guess this is the interest part. Or this is the principal part and this is the interest. You can see that it's about 50-50. So half of that $1,000.25 that I pay every month on the loan that they're leaving in place, half of that's going to principal reduction. That is really, really powerful. Okay. Now, so that means that every month that this loan stays in place, I'm building wealth through the amortization, right? Because the pay down on this loan is going down so well. So when I wrap this note to somebody else, and so let's go back and create the one that I'm, potentially putting in place for someone else. So if they give me $200,000 with $40,000 down, so we have a $160,000 note, wrapping $140,000, right? And I've at least got to cover this payment. So this is a pretty good 6 3/4. This is a pretty fair private money rate. I'll amortize that over 360. So that's their monthly payment is $1,037. So I'm not really making much of a monthly spread on this, but check out the amortization, the difference in the amortization. So here again, I go to that orange shift key. I go to the amort button. My origination date on this, let's just call it 12/1, because I'm right in the middle of this deal. Okay, so we make that. I'm going to share that, and I want to expand that so you can see it bigger. This is 2. Save. Okay, so when you look at this amortization, the loan that I'm creating for the person buying it from me, can you see that? Look at the difference here. Their first payment on January 1, their payment is $900 interest, and only $137 is going to principal reduction. And remember over here, we saw that same payment on January 1, almost $498 is going to principal reduction. So if you do the math, just on, and it's always increasing, right? Because the rate I'm paying on, I'm creating that yield spread. So the loan, the 4 point something that I'm paying on is amortizing much more quickly than the loan they're paying on. It's still a good deal for a private money deal. Also, I left a lot of meat on the bone, this property would sell for more than $200,000. Anyway, you can see that if I take, basically the difference, the 500 that I'm paying down, and they're only paying down 137 on that same payment. So what is that? Where's my calculator? Come back up. So basically 498, I'm getting that in principal reduction on the loan I'm paying on, and my borrower that right in the beginning only getting 137 pay down. So you can see that that's $361, and that number is only going to get bigger. That number is only going to get bigger with each month by a couple, $3, $5, whatever. But you can see if it just even stayed the same. So if I make that's invisible wealth building that's happened. I'm not going to realize that money yet, but it's like money's growing and putting into my future bank account for me to withdraw later. So times 12, every year I'm making $4,300 plus in hidden future value of this note. I don't know if that makes any sense, but I wanted to put that out there. I thought this was a great case study for, by the time let's say it fully amortizes out and they take that 30 years to pay down this loan, but my loan's going to be paid in 16 years. So even if they made the minimum payment, I've got, long after that existing bank loan is paid off, I'll have another 14 years of $1,000 a month coming in, with the bank loan being gone. So you can see that, gosh, that's a great little stipend. One deal can give me a future residual pension of $1,000 a month, and I don't even have to be a landlord. So anyway, I just wanted to show you that power. It's usually a hidden value that people aren't used to seeing or considering, but it is powerful. So even if this runs another 10 years, I'm creating, by the time this loan pays off, let's say the people that are buying it from me pay it off in 10 years or they sell it or whatever, $4,000 a year times 10 years, that's $40,000 extra in payoff that I have coming just because of that yield spread and the differential in the interest rates. So, and the fact that I'm taking over a seasoned loan, one that's been in place for a while, because that amortization is so fast. So I just wanted to show you a little bit of the magic of that. So I hope that was sort of interesting. I really love those sorts of things a lot. So Axel, let's go ahead. If there's any housekeeping items, or if there's anyone who's chatting in or anyone who's on our email list here that's actually live on the call, I'd really love to prioritize those people. So can you kind of take it over for a second? Or if anyone has any questions on the deal on the example that I just showed, this would be a great time to.
So if you have any questions regarding the wrap and what Donna went through, you can chat them in, or you can simply unmute yourself. Bottom left corner of your screen. If there are any questions related to the wrap tutorial, we're going to go ahead and open up the lines to a few people that sent in some questions. Let's start with Nomi. Nomi, can you unmute yourself?
Nomi, how are you?
Hey, Don, how are you doing?
Hey, good. Just out of curiosity, since I'm thinking of it, have you created a website to show people that book that you wrote, or an Amazon page?
Yeah, it's on Amazon. Mm-hmm. Notes to Notes, how I went from music to real estate. Just look up on Amazon.
Notes to Notes.
And I love when people leave a review. So if you've read the book yet.
Yeah, well, I love, even that's, let me bring up Amazon. When everybody has their own journey, and it's super cool, for you to share your journey. Mine was nursing to notes, right?
Yeah.
From nursing to notes. Yours is from, music to notes. So, if you love to write, or you have a story to tell, write a book. It's super easy. Here it is, right here. It is super easy to get self-published. Share your story and position yourself. If you love this business and you want it to be more than, I don't know, just I'll invest here and there a little bit. If you really love it and want to get into it, why not position yourself, tell your story, or just write about things that you love, and put your own spin on it. So I would suggest that everybody consider becoming an author, an educator, and a sharer of life stories. But anyway, this is Naomi. Thanks for that. I mean, you're on my calls. You've been to a couple of the summits. It's really great to have people that just stay a part of your world.
And still learning, though.
Well, we're all still learning.
Exactly. That's why I'm still on the call.
I learned. So anyway, just another example of just a regular person who's like, you're not regular. If you were in the music industry, you had a little bit of a different life than most of us. But anyway, just thought I would bring that out now. So what are we talking about today?
Well, I stumbled across a great opportunity in the Dallas area of buying 22 houses for $2 million. Now, I don't have $2 million or anywhere close, but if you can do the math that each house ends up costing less than $100,000, and the average resale price would be $175,000. So there's a big possibility of making a huge amount of money there. So I was approaching it, and my first idea would be what you had said in your original statement about a wrap, asking the seller basically to finance it to me. I've never done that. I've never asked a seller, so I wanted some tips on doing that. And then if that doesn't succeed, if they don't agree to it, I wanted some advice about whether to do a hard money loan with somebody or whether to do a JV with somebody. Just different ways of doing a large project like that.
Yeah. So basically, this person in exchange for selling them all at once is willing to leave like a lot of money, 40% equity on the table, basically.
Exactly. Yeah. Exactly.
And do they own them free and clear? Do you know?
I think some of them, but some not.
Interesting.
But I think most of them are owned free and clear.
Mm-hmm. And you're pretty sure of the values? And are they all rent flowing and all that?
About 80% are occupied and 20% are vacant. And I am sure of the values. I've underestimated the values. So I think 175 average is underestimating the values, which I like to do. I like to have a little room.
Oh, that's really smart, because where we really get into trouble in this business is overestimating the value of the collateral. Because when it comes down to it, something goes sideways, the collateral is all you're going to get. And sometimes that can be a really painful wake-up call when the BPO, when you bought the note, was twice as high as the BPO when you took it as REO. You're like, what the heck? What happened? In some areas are a lot harder, like the South. It's so tough. In some areas of the country, you just can't even count on an online evaluation, or even a BPO can be misleading. So it's you have to be pretty careful. So, all right. So what's your first question? Just how to ask? I just ask.
How would I phrase the question to somebody who has no experience with seller financing? Like, how do I approach it with the best chance of success?
Well, basically, I'm just having a real life conversation with someone. Okay, so you want this? Is that like a cash price, or if I can get you that, I can get you that price. But if you can, if you give me some time to get you that money, would that work? Would you be willing to carry? Because I can give you that price right now. But I'd like you to give me some time to be able to get you that price. Like, can I pay you over time on this? Can I, would it be okay if you accepted payments? Or, basically you have to go. You cannot create motivation when there is none. Like, if they're cashing out for a reason and they need that cash and they already have a plan for it, the whole cash amount, you're not going to be able to change their mind. But usually people don't know they'll accept an owner financing offer till they're looking at one right in front of them. Okay. So I would just offer, I would just say, hey, basically I would approach it as a letter of intent, 1-page letter of intent. Kind of here's what I'm thinking. What I'd like to do is put down whatever it is, 10%, 20%, and just have you carry the rest, right? And just see what he says, because a lot of times it's like, gosh, what are you going to see? This is where you have to create rapport and trust, because you kind of can ask some personal questions, kind of can sound kind of personal, like, well, I am not trying to be nosy, and I know this might sound a little weird, but I'm just wondering, what do you plan to do with the money? Most people are looking for cash flow and for growth, a monthly income instead of a big wad of cash. A lot of people are going to stick it in a 1% bank account or CD, or maybe they can get 3 or 4% on an annuity or something like that. What if you could get 3 times that by willing to be carrying paper? And plus they defer capital gains, of course, potentially. That's for their CPA to determine, but potentially they can defer capital gains, have income for retirement secured by property they already are comfortable with, they already know, and then they can still leave a good inheritance for their children, because most kids don't want to inherit rentals. Very few are equipped to be good landlords, but an automatic payment coming in on a big mortgage is really nice passive income, right?
Okay.
So basically, when I started my whole career and just carving out the niche that I liked in it, it was from call after call after call, talking to people who had small portfolio of rental properties. They didn't want to manage anymore, but they didn't want to sell even for a good cash price, because they wanted to defer capital gains, they needed income for retirement, and they wanted to leave a good inheritance for their children. So to me, owner financing for a lot of people hits those 3 things really perfectly. It's just that there's not a lot of awareness about that topic, in the general mainstream for some reason. So
you would basically approach them with a deal of creating a long-term note to them. That's where I was confused. Should I tell them, oh, I'll give you a note for a few years till I sell these properties off, and then I'll pay you off? Or do I ask for a loan?
When I'm buying, when I'm the buyer, I want the longest terms I can get.
Okay.
Because I don't want to be up against, if I'm the buyer, I want the longest terms I can get, the lowest interest rate, the longest term I can get without a balloon, ideally, because I have the option to pay it off earlier if I want to, but I'm never going to be stuck against a balloon if there's a hiccup in my life or in the market, at the time that balloon comes due. I don't like it. So when I'm buying, I want 100-year financing if I can get it,
Okay. Mm-hmm.
I mean,
now if the woman or man, if they answer me and they say, look, we're doing some 1031, we got to get it cashed out, or we're doing this or that, we need the cash, and it turns out that I can't get them to seller finance, what would you recommend as a backup plan? A JV partnership or hard money loan?
Let me just ask you this. How much of your own cash out of pocket do you want to throw at something like this? Could you, or would you?
I could probably do 10% of my own.
So you could throw $200,000 at this.
Yes.
So an $80,000, 80% loan on this. Could you get bank financing?
No, I can't. I haven't been in business long enough. Right.
So, okay. So I'm in the absence of a portfolio lender who will cross collateralize on the whole portfolio. Sometimes those are out there. They're surprising.
I haven't been able to find one yet. I'm not saying I couldn't try again, but so far they keep looking at my track record and saying, "Oh, you haven't been in business long enough."
Right. So you're looking at a $1.8 million loan, right?
Yes.
And what do you think is a reasonable hard money rate?
Well, know about reasonable. I haven't seen anything reasonable. They're all high.
Okay, really? I mean, really, I would guess that's I don't know, but let's just go, you have to do 2 and 10, right? 2 points, 10%.
Okay, yeah.
Even interest only, without any amortization at all, is $15,000 a month. That's
Huge.
scary.
Yeah.
That's
why I'd thought about just doing a JV partnership, but I've heard people warn against that, saying you lose a lot more money in a JV than you do in a hard money. But I don't know. I've never done this kind of thing.
Okay, but just think about this. If you have, let's say you were successful and someone would loan you that much at 10%. If something goes wrong, you're on the hook for 15 grand a month, whether the properties are performing or not.
Right.
When you have right? So you're keeping all the upside, but you also have a lot of exposure to the downside when hiccups. JVs protect you. Yes, you're giving more of the backside up, but you're having a partner with you that will ride the downside, so you don't have this debt payment to make. Right? If the money's not coming in for some reason, or let's say they're all in the same geographic location and there was a tornado that ran through, and it's going to be a while till you get the insurance money. You don't want to lose everything because you can't afford 15 grand a month. You got a partner that you're both taking a piece of the pie, but yes, you're giving up the equity, but I wouldn't want that much debt. I would much rather have a JV partner on something like that.
How would you structure that JV partner? This would be my last question. How would you structure that JV kind of deal? I've never done a JV deal like that.
Yeah. I mean, I haven't done anything like that either, but typically you have some sort of, you've got the sweat equity partner and you've got the money partner. You can also be part money partner. So, I mean, even though you're only putting up 10%, but if you found the deal and you're doing all the work, I would say, let's just call it a 50-50 split, right?
Okay, yeah.
Or 60-40, whatever it is like that. Maybe you take 60%, they take 40%. But then I would say some sort of preferred return. I think this is fair. Let's say they have a 6 or 7% preferred return plus 40% of the upside as you sell and roll out of these things. So they have a really, really, like their minimum, they're going to make their 6 or 7%, right? For that same 1.8, and let's just I guess we'll leave it as interest only. But if their preferred return is 6%, then the amount that they're owed every month minimum is $9,000.
Mm-hmm.
And if the payments don't come in from the rents or the whatever, then there's no money on the table. But whatever's coming in, they get the first $9,000, and then as you roll out of it, they get a portion of that equity. Then they're doing really well, especially if the valuation comes in at $3 million on this instead, $3 million plus. To me, that's kind of what I would ballpark it, give or take, depending on who's coming to the table. And you really want to know, like, and trust that person. You're like, it's like getting married, right? Or so you can see that if they get 40% of doubling the money on each of these assets as you roll out of them, their overall yield's going to be well over the double digits.
So would I take their 8%? Would I take their 8% out? Like if I paid them $9,000 a month for a few months, would I take that $9,000 a month out of their 40%, or is that included on top of their 40%?
No, so it's whatever it is. So basically, the higher their guaranteed return is, maybe a little bit the lower their overall equity, right? So if you can get them down to 5, they should get this. Now, if you can't guarantee that, if something happens and the cash flow is not coming in, that's the beauty of a JV. If there's no money coming in, they're not getting any money, and it's not like you're going to make it up to them, right? Your partners in, right? Yeah. But so it's just or if they need a higher preferred return, then I would say they get less of the equity participation. Does that make sense? That's how my thinking kind of goes.
No, that's very helpful. Thank you.
Okay, thank you, and good luck on that. Always great to hear your voice.
Yeah, you too. Have a good
All
Thanksgiving.
right, thank you. Yeah, same to you. All right, Axel, anything else before I just kind of go down this list? Who else is actually here? I see Sam Soni is here. Where do I start in this note business? That person I see right there on the screen.
This is Sam here, Sam Soni.
Sam. Hi, Sam. Tell me a little bit about yourself. Welcome to the call.
Hi.
Hi.
I'm based in the United Kingdom.
Oh, wow.
Yeah.
It's
and
the middle of the night. What is it? What time is it over there?
It's 5:30. 5:30 in the evening, 17:50 or 17:30.
I thought it would be later. Okay, great.
No,
this is
just about 8 hours ahead. Well, basically,
Yeah.
I have a Florida company. I'm trying to start in the note business because we don't have it in the United Kingdom. It doesn't exist. The business doesn't exist here. So I'm trying to see where do I start to learn and then start to do the business. Do you have a course?
I don't have a course. I have a lot of material that as I was mentioning, you know what? I just don't sell anything at this point, except for the yearly conference that I do. Sell those tickets for people who want to come join in. But when my site is up and you can log in and see the dashboard, and there you can check out my links to resources. So just give us a day or two. Hopefully Google will have re-indexed our site and we'll be up and running again. But I have a links to resources and I recently updated this after my conference this year. I updated this links to resources page just to answer this exact question. Like, here's the people I trust in the business and they're very affordable ways to just start getting your mind into it. And then there's really, you don't have to spend a lot of money to learn the note business, but you need to spend some time. Or if you have more money than time, then you pay for someone to hold your hand. You don't mind spending $20,000 or $40,000 for someone spoon feeding it to you, or you spend the time and a few $100 will go a long way. Ultimately, just like in a lot of businesses, it's a people business. So you're going to do better if you network and connect and go to a few conferences. And I've linked to the ones that I would suggest, and I'm sure there's more. At least it's a place to start for you. And anyone else listening, just check out that links to resources, and just being on this call and starting to just consume and hear these concepts over and over starts giving you a way to organize it. And Axel, how far are we from getting, I think in my initial, at the conference when I opened up the keynote speak kind of thing, I went over kind of the basics of it. Is that up yet? Or so I'm just going to show you real quick here. Gee, I don't even know how to log in. Oh, okay. I'm just going to show you real quick. Thank you. I didn't know I could even get into that, Axel. So this is what it looks like on the dashboard, and this is free. This is where I've just aggregated all of my free content or links to things to make it easy for people. Here's the links to resources I was telling you about. Just check that. And then here in the summit, is this the most recent one? Okay, so right here, there's a really good, at least in the way that I like to present, like creating the overall, where this fits in the world, where the note business fits in the world and why it matters. So I would suggest at least going through that session 1.
Okay.
Where I try to, lay that out in my fashion. So, but everyone has a different style. And then, if you just read the little books like the Seller Financing on Steroids, and even Nomi's book, anybody's, it's not that expensive to just get your head into it. And like any business, it's more about, every business comes down to marketing, promotion, and sales, right?
Sure.
I mean, you've got to get the leads. And so how do you get the leads? So it becomes, you've got to establish yourself to get referrals. You have to do some direct marketing. of some sort, or SEO, but that's where the relationships come in really powerfully, because to get deal flow sooner than later, it's about the relationships that you create. And then you got to figure out, where do I fit? Where do I fit into this overall conversation? What's a good fit for me? Am I the just private lender type? Do I want to only buy first position owner carries? Do I want to, or do I like that idea of the non-performing seconds? There's whole people that's all they'll buy is non-performing junior liens.
Okay.
So you have to figure out, where do I fit? So I hope that helps.
Thanks. That's great. Thank you.
All right. Thank you for being on the call, and good luck in your journeys.
All right. Thanks.
Thank you, Sam. Okay. Who else on this list is on the call? Do we know? Anyone who wants to unmute that's here?
Yes. Hello?
Hi.
Yeah, my name is Jason. I'm calling. You were going over wraps.
Yeah.
How does that work? Is that something that's still? I've gone to various real estate groups, and some people say that they don't exist anymore. Other people say that you still can do it. How does that work? I mean, is a wrap meaning that you're assuming the mortgage, or you're actually wrapping the mortgage?
Yeah, so there's very few loans anymore that you can assume. I think there may be still some VA loans out there that allow a formal assumption, but generally you're just leveraging the existing financing.
Okay.
So sometimes you call it either subject to or a wrap. Basically, in this case, look, I can pay you a cash price of this, or I can add 20 grand to that if you'll let me leverage, if you leave your existing loan in place for me, right? And so the loan's just not getting paid off. The loan's not going to be paid off through the escrow. And I guess what I learned from, one of the things that came out at our conference is, and this seems to be true, is that title companies aren't going to do a wrap if the underlying financing is what is it, FHA? Yeah, if it's a FHA loan, they won't record a wrap. So you kind of have to use a different deal structure to get that done. So there's different ways. There's different ways for the paperwork to look, but the concept is very much alive and well. Yeah.
Okay.
Right. So the paperwork can look different depending on the deal. But what that means is the existing loan is not getting paid off, and then I'm creating a bigger loan, right? I'm creating a bigger loan that's going to be inclusive of that original amount. Like in the example that I started with, I'm not really making a spread. What the payment I would owe to the bank is $1,025, and I'm only charging $1,037. So there's only like a $12 spread. That's not where the juice in this deal is. The juice is at the front, the larger down payment, and then the spread in the amortization over the remainder of the loan. That's where the juice is in this particular case.
Okay.
Right. So, but a lot of times there's easily $100, $200, $300, $400 spread in the monthly payment.
Okay.
Right. So, but the concept is there, and you can do it. The concept is there with a lease option as well. So you don't even have to take title to the property in that case. Title isn't even changing, but what you're doing is creating a spread. So if the seller says, look, my house isn't selling for the price I want, I need to move town, I'm not going to sell it for, 70 cents on the ARV, right? I'm not going to do that because, let me rent it for you. And they don't want a property manager, right? So basically I would go to that person and say, give me a master lease. I'll pay you $1,500 a month. If I know that that same property, I could rent out as a sandwich lease option. I could rent that out for $2,000 a month. I can create $500 a month passive income and never take title to the property. It's just the differential in the lease agreements. So what the whole concept is arbitrage. How do I create a spread? Either it's an interest rate spread or a rent spread. And the value you're creating for someone is they don't have to have a property manager. You know, you're going to take care of all the brain damage of the little things, right? If the roof blows off, their insurance will cover it, right? They stay as the owners. And so I really expect, I really expect that to be in this market we're here in Northwestern Nevada. This lease option thing where you don't have to get such a low price to make cash flow. Like, I don't really, like, what do I care? What do I care the value of the property if I can put $5,000 down option fee and I can rent something as on a master lease for $1,500, and then I can go and get $15,000 from someone else and charge them $2,000 a month. I don't even care what the strike price is. I don't even care what the market does, because I'm getting a bigger option fee than I paid out, and there's a $500 spread on the monthly rent. Does that make sense?
It does. It just seems like trying to. I mean, I understand you're making payments, but what happens if your tenant stops paying? And I mean,
well,
how
then
does
you're
that
still
work?
you're on the hook, right? You're on the hook to pay the underlying no matter what, right? Unless you want that deal to fall apart. But what you do is just evict that person. You're going to evict them and then get someone else to replace the deal. So that's where you need a little bit of reserve capital, because sometimes you have to be able to make certain payments or cover certain costs in between. You know, if there's trouble. Wow, that sun is bright.
Don, do you have any experience with mobile home parks?
With what?
Mobile home parks. I'm sorry if I'm kind of low. I'm at work, so yeah.
Oh, right. You're trying to sneak under the bed.
Yeah. Yep.
Yeah. No, I do. I have more experience in mobile home parks than I want at this point.
Okay. Yeah.
No, actually, they can be very, very lucrative, but you can also there's different set of things that you need to be aware of when I don't have the experience of owning the park, but of dealing with mobile homes in parks that I've rehabbed and flipped and carried paper on. And there's a whole seminar I could do just on that, which I probably am going to be putting together, a few focus materials. Probably, I always say that every year, but I actually have my son doing a lot of art for me so that we can get some of these concepts up. So always keep posted. If you keep posted, we'll send out an announcement as I get different little trainings up and available on the downloading things.
The reason I was asking, I'm looking at a mobile home park. It's about 25 lots, and I don't have all of the information on it. And the original owner, I believe he passed away, and he left it to his heirs. It looks like they want to get out. Like I said, it's 25 lots, 13 are leased up. I think there's like 6 that are vacant, and there's a few lots that doesn't have anything on them. They're asking around $300K for it. I believe it's tenant owned, so most of the mobile homes are tenant owned, not park owned.
They're rented.
So they're
so they're
collecting
owners.
lot. Yeah, so
Yeah.
they're collecting lot rent. When I look at the numbers as they stand right now with the 13 leased up, I would break about even. I mean, there's upside there. I don't have cash to get in. So in that situation, how would you look at it, or how would you try to get in if it's actually a deal?
Well, number one, I wouldn't, me personally, because there's a park here in Carson that I would love to own at some point, but I don't have $6 million. I don't even have 10% of that cash that I could put just towards the one thing. Well, I would have to liquidate out of some other things. Let's just put it that way. And I don't even know if I would. So I would always bring in partners because they're it can be pretty complex. So I would bring in someone, consultants or partners, and have a team of people to help evaluate it. But if it's a good enough deal, there's always money for it. The only time you have trouble getting money for a deal when it's not a real deal. So basically you either have to get a really great cash price, and you got to know the business. You can lose your shirt on it, right? People can overestimate what these parks can do sometimes. But anyway, I would partner up with people. If I couldn't get below market cash price, and it's so good of a price that if you can't attract in a private money partner, it's not a good enough deal, frankly. Or you got to get 0% down or 5% down, 10% down, with killer terms. So I have to have below market price or below market terms to buy anything.
Okay. Well, would you even look at doing a master lease? I mean, I don't. It's not
in that
leased
situation. That would be really strange. That would be strange. Okay. No.
Because I don't see how you would get bank financing for any of it, because it's not
a
totally
lot of
leased up.
these things. No, and if there's a lot of vacancy, that's where you can buy it at the present cash flow, get the spaces performing, and then sell it for a lot higher. It's really common, just like you can do with apartment buildings, right? B and C apartment buildings. You buy it, there's 35% vacancy. You get it fixed up, you get it to 90, 95% vacancy, or you know what I mean? You get the vacancy rate way, way, way down. Then the cash flow is so much higher that you either do a cash out refi with an institution or sell it for double what you bought it for, right? So there's a lot of upside to be had there, but it's a pretty complex business model. I wouldn't say that's for the brand new investors to just all of a sudden go in and buy a mobile home park. I mean, even I wouldn't do that. I would bring in teams of people. I would never do that on my own. So anyway, that's just me. But anyway, thank you for asking the question, Jason. What part of the country are you from?
I'm Northeast.
Northeast?
I live in close to DC. I'd say that. Gotcha.
Well, great. Well, I appreciate you chiming in and being here on this. But the concept is great on the wraps. It's whether you're just trying to create a spread, because cash flow is king. Cash flow, however you can create cash flow with the least amount of risk, so much the better.
I'm trying to learn that how to do it in a way that's going to protect me and protect the people I'm working with. So
absolutely, you have to do it. It's got to be a straight up deal for everyone, or you're just asking for a nice karmic visitation.
Yeah.
Yeah.
I agree.
All right. Well, thank you very much, Jason. All right.
No problem. Thank you.
All right. Take care. All right. So we've got about 8 minutes left on this. Is there anyone else that wants to unmute and chime in?
Oh, okay. I'm here. I'm Gene.
Hi, Gene.
Hi. How are you?
I'm great. Tell me a little bit about yourself.
I've been advertising for probably 5 months now to buy mortgage notes. I'm with a company down in Texas that buys them, and I get a commission on them. And I've been advertising every 3 or 4 days, and I think I've got maybe 3 calls. So I don't know.
So you're trying to broker notes or wholesale notes, right?
Yeah, for now, until I get enough cash build up so I can buy my own. Yeah.
Right. So how are you choosing to advertise?
I've been using Craigslist most of the time for advertising.
Okay. Yeah.
I don't know if it's the method or what the problem is. So.
Well, so just in general, and going to this links for resources, places to shop for loans or discounted notes. You got, whether you're an investor or a broker, I will tell you that this space, it is incredibly competitive. The margins are thin. There is just a ton of money looking for real estate and paper assets to buy. So I will tell you that there's almost, it couldn't be more saturated than it is right now. So it is going to be a challenge. It really is. And, I would suggest that if you listen to what it takes to be really, really successful in the business, I mean, it's not like you can't get a few deals, but I will tell you that as soon as you can make the leap in your mind, when I was new into the industry, and basically I'm still working as a nurse, raising my kids, and going to these note conferences and other things, the people that were trying to influence me and that ultimately shaped my whole approach to this business were always saying, don't think like a broker, don't think like a wholesaler, think like an investor. And it's better to, they said it's better to keep a little piece of every deal than to just take your fee and move on. And basically I have a couple of, I got a home investor guy here locally with me that I work with him very closely. And, you can make great wholesale fees once in a while, but if you have a month, a couple, 3 months that stack together and you don't have a deal, you're really wishing that you'd kept a piece of things, right? If you had $200 spread on something, you didn't take 20,000 up front, you kept $200 a month cash flow off of the deal, whether it's a note or real estate deal. And you had 10 of those, then you have $2,000 a month coming in. That's your base salary, so that you don't sweat it. You got your rent, your mortgage covered because you've just built up enough passive income so that you can make it in the business. So I would say as soon as you can, think of buying, because it's a lot easier to directly buy a note than to try to broker it and fight everybody else who's, if you're seeing it on Craigslist, I can almost guarantee you it's being shopped up the yin yang to everyone. Everyone and their dog has seen it. Everyone's working it. And if it's a good note, and let's say they're all taking it up the food chain to one of the, like FNAC, one of the larger institutional buyers, the only way you're going to get that deal is if you'll take less. It's about who will take less. XYZ company will pay $50,000 for this note. Okay. How much are you willing to take? So whoever takes the smallest commission gets the deal, right? Whereas if you're the note buyer, you have a lot more flexibility. You cultivate your own money partners and start taking these down and keeping a small piece of it. Really. And if you really want to see like the no BS sort of thing, check out, I guess we probably have it up here. Where's Abby's? Abby's. Look, he shouldn't even have all this up here for free. I'm telling you, he shouldn't even be telling all this. You want to know what it takes to be really successful note broker? You should probably be listening to this session 10 from our conference this last October, and you'll get you'll see this level of sophistication that's going into being competitive and really doing well in this business from just a broker's perspective. So I can just recommend you there. I know we're about done with time, but does that help a little bit? It can be rough. And kudos for starting.
Yeah, it's been pretty rough. But like I said, I've been advertising about every 3 or 4 days, and all up and down the East Coast. I got ads running in Maine and New York, upstate New York, New York City, and Pennsylvania, and Ohio, West Virginia, North Carolina, South Carolina, Georgia, and I think I've got 2, maybe 3 calls on them.
Right, and so what you're competing with is people who are spending several $1,000s a month on direct mail, and or SEO optimization or paid advertising, pay-per-click. You are competing with people spending thousands of dollars a month to get those leads before you do.
Right. I kind of figured that, but I wanted to make sure I was going to have a definite market before I start spending a lot of money on it,
Right. So it's good to go, is this really my gig? You better love it, because it's like any business. It's a significant investment to get started. Now, if you have investment capital to work with, buying a note's not that hard. Hook up with the people who have the deal flow and start investing. To me, it's easier to get a capital partner to come in with you, in my mind, to say, hey, we're buying this at an 8% yield. If you take 7, I can make a 1% spread, and we'll start putting a portfolio together, right? And you can take deals that are already sourced out there. You don't have to create a whole business from scratch. So to me, it's much better and easier to cultivate a financial partner who's willing to take a spin with you on this stuff. But you got to make sure you can underwrite the deal, and you can manage the deal, and you understand it well enough that you're making good choices. So the easiest way to get started in the note business is to cultivate private parties, financial friends that will just take some of these down, and you keep a small spread. That's how I started. That's actually ultimately what changed my trajectory in this whole business, is the minute I quit trying to broker a deal. And I just thought like an investor and just brought in in the beginning, I had to pay a lot more for my private money. I think my first deal I took down, a friend of mine took a spin with me. He said, and I paid him 15%. It was like $15,000, and I paid him 15%, but I still made $75 a month spread, because on this small little partial, I think I had bought it at a 25% yield. And so even though it was a small deal, I still made $75 passive income above what I owed my friend. Now, I don't pay near that much for money anymore, right? But whatever it takes to get started, if you can make $50 a month passive income out of thin air, more passive income this month than you had last month, that's what you're after, is that trajectory. Start changing that trajectory, and before you know it, you look back and go, oh my gosh, I've created base salary for myself. Now I'm free. I'm free. Right?
Yeah, right.
Okay.
Well, it's been a pleasure talking to you. And
Thank you so much. I appreciate you. You too, Gene.
All right, bye.
All right. Bye-bye. Okay, everybody, that's all the time we have for today. I wish you all, there's so much for us to be grateful for. It feels like the whole nation, in my whole life, I guess in my personal life and in the nation and even in the world, maybe feels like we've kind of been under a pressure cooker this year. I don't know. It's been a humdinger of a year for me in a lot of ways, but there's really so much for us to be grateful for. And, for us to just, my wish is that we can focus on gratitude and being more loving and gentle with ourselves and everyone else. Everybody's going through a lot. So anyway, I'm very grateful for you. And we will talk, I guess, before Christmas next month. All right. Take care, everyone. Remember to use your powers for good and go out there and create financial solutions, just one mom and pop to another. Take care. Bye-bye.
You've been listening to Virtual Coffee with Dawn Rickabaugh. For more, please visit notequeen.com.